Hello, I'm RASHI GOEL and I'm pursuing BLLB from University of Petroleum and Energy Studies, Dehradun. And currently, I'm a legal intern at LEXIS and Company. So, in today's video, I'll be talking about Double Tax Avoidance Agreement, that is DTAA. So, what is DTAA? Its full form is Double Tax Avoidance Agreement. It is a tax treaty agreement between two or multiple countries to prevent double taxation of income earned in both the countries. For example, suppose a company in India invests in USA for construction. The question which arises is whether such company is liable to pay tax in both the countries. So the answer is no. The key objective of Double Tax Avoidance Agreement DTAA is to ensure that there is no tax evasion, exchange of information between the countries, and to prevent double payment of taxes. Such agreement ensures that the tax to be paid shall be borne by the company only in one of the countries. DTAA can either be comprehensive agreement, which covers all the sources of income, or can be limited to specific areas such as taxing of income from air transport services, shipping, etc. So the need for double tax avoidance agreement arises due to improper method in collection of taxes globally. If a person aims to do a business in foreign country, then he or she may end up paying taxes in both the countries, that is, in country where the income is earned and in a country which company belongs to. Or in such cases, in order to avoid paying double taxes, such companies may adopt the method of tax evasion. Thus, in order to avoid double taxation and tax evasion, the need for Double Tax Avoidance Agreement DTAA arose. And such agreement also kept the both countries well informed about the activities of such company in the source country. Now, further let's talk about its advantages of DTAA. There are various benefits associated with Double Tax Avoidance Agreement. The basic benefit that includes is not paying of double tax on income earned, and benefits like tax exemption. Let's say India imposes 10% tax on capital gains. Now, if Government of India notifies that it shall not collect any tax on investments which are coming from Australia and exempts Australia from tax on capital gains on any investment, then this is known as tax exemption. Next benefit is lower tax rate. Let's take the same example. When India imposes 10% tax on capital gains, it notifies that it shall collect tax on capital gains at rate of 5% and which are investments which are coming from Australia, then this concept is known as tax reduction. And third benefit is refund. Let's say when a company from India invests in Australia and pays $100 as tax on income earned in Australia, then India may refund $100 or a part of such tax to X. This is known as refund in concept of DTAA. Hence, the outcome of such agreements are the double taxation on income earned will not take place. Such agreement may promote bilateral investments between both the countries and multiple countries. Also, it will promote more clarity and transparency in terms of investments. And lastly, it will promote trading from global perspectives. Also, DTAA in India includes many types of incomes on which non-resident Indians need not to pay taxes twice. So the first is income received from services provided in India. Second, income from salary received in India. Third is income from immovable property in India. Fourth, income from capital gains. Fifth is income from fixed deposits in India. And last, sixth is income from saving bank accounts in India. Next, let's talk about the misuses of DTAA. It is a treaty shopping where a national or a resident of third country seeks to obtain the benefits of DTAA between two or multiple countries by impersonating as a company or other entity in one of the other country. Thus, this concept is known as treaty shopping, which is one of the misuses of DTAA. Let's take an example. When investor of India invests in Australia and makes certain amount of income. Now ideally in this case Australia shall pay tax of suppose 10% on this particular income. Now let's say that there is another DTAA between UK and Australia, in which UK is exempted from paying taxes on income which is earned from investments by UK. Thus, UK will not be paying any kind of taxes. Now, when a company of India routes his investment into Australia via UK, he will pay tax at 0% on income earned, because UK is exempted from tax by the agreement between Australia and UK. Thus, when an investor from a third country routes his investment from a country which has got an agreement with the sources of the country, where investors end up paying very less tax or no tax at all, then this concept is known as treaty shopping. To reduce this misuse, the countries includes a clause in their agreements which says that or which is known as limitation of benefits clause, LOB clause, which will determine which of the investments are done only to get the benefits of double tax avoidance agreement, or which are true investments. For example, in the case of DTAA between India and Singapore, the limitation of benefit clause mandates that the particular investor making an investment in India should have incurred the expenditure of at least 2 lakh Singapore dollars and in a period of 12 months preceding this the investment being done in India. Thus, putting a limitation of benefit clause, such clause aims to prevent misuses by methods such as treaty shopping. So, double tax avoidance agreement DTAA is a treaty which indeed helps in removing ambiguity of paying tax twice and at the same time ensures that there is no tax evasion by exchange of information among both the countries. But the most important thing to keep in mind is to prevent the misuse of the agreement by not adapting the method such as treaty shopping. Thank you everyone for watching my video. I hope you guys liked it, and if you did, please give it a thumbs up and share it with your friends and family. And don't forget to let me know your feedback in the comment section. Stay home, stay safe, stay healthy.